Good afternoon and welcome to our live webinar, Guaranteed Income for Life, Planning for a Secure Retirement. On behalf of the entire team at DIETRICH and ANNUA, thank you for tuning in. My name is Krista Kotelis and I'll be the conference moderator this afternoon. If you have any technical difficulties with your webinar software, please direct those questions to our tech manager, Lisa Straub, via the question area on your control panel. Any questions asked during the live session will be answered at the end of today's presentation. They can also be sent via the question feature on your webinar control panel. Any questions that we are not able to get to will be answered offline. Our panelists for today's session are Jeff Dietrich, Executive Vice President of DIETRICH, and Jay Washington, Client Relationship Manager with DIETRICH. Jeff works directly with plan sponsors, actuaries, advisors, pension attorneys, and the highest rated life insurance companies to provide custom retirement income solutions. Jay works directly with plan sponsors, retirement plan advisors, and insurance companies to provide pension plan risk advisory and insured retirement solutions to promote the financial health effectiveness of retirement plan sponsors, the plans they manage, and the retirements they support through education, objective advice, and access to institutional solutions. So at this time, I will go ahead and turn the presentation over to Jeff and Jay.
Thank you, Krista. That's a brave thing you're doing there. Hopefully, us lack of technical savvy people can handle this. But welcome, everyone. Just wanted to get something out of the way. I hope everybody enjoyed National Chicken Wing Day yesterday. I had the privilege of stumbling across Joey Chestnut eating wings for 12 hours, and it's something that I'll never be able to unsee. But thank you for joining us. As Krista mentioned, we have a kind of a twist on the webinar. Typically today, a deviation from our normal business here at DIETRICH. It's exciting and some new things to introduce, some new people to introduce. But as you know, our general mission here at DIETRICH is insured solutions for retirement plans. And while pension risk transfer is still a very busy part of what we do, we're going to be talking about a new focus of ours, something that we've been working on for a little while here and that we're very excited and passionate about, and that's guaranteed income in the retirement space on an institutional basis with defined contribution plans. Just to touch base on pension risk transfer and plan terminations, I give everybody that second half of the year alert. If you do have any clients that are looking to conduct a settlement this year or are in plan termination mode, as we all know, the fourth quarter tends to be very busy, and it's time to start thinking about lining up those opportunities for year end. So please reach out if there's something that you foresee coming by the end of 19. So as for today, we're going to start setting the table with some general insights of ours, the need and lack thereof of guaranteed income in defined contribution plans, legislative changes and momentum on what we've been seeing in that space. And then I'm going to, turn the presentation over and welcome one of the newest members to our team here at DIETRICH, Jay Washington. He's going to introduce ANNUA, as I mentioned, our exciting new defined contribution practice, and we'll get into talking about ANNUA's purpose and some of the solutions. We'll close with standard Q&A session, but please, if you have questions along the way, please send them in, and we'll be sure to get through this as quick as possible so that we can get to all the questions. All right, so let's get started here. Got it. Made the first slide transition. As I mentioned before, as a group here at DIETRICH, we feel very strongly that the industry as a whole, plan sponsors, administrators, plan advisors, and insurance companies are in a unique position to make a difference in the retirement of plan participants, employees. And as plan sponsors continue to shift away from the traditional pensions, which was once the primary retirement savings vehicle of individuals, defined contribution plans come to the forefront, and they're now the primary savings vehicle for retirement. Once they were a supplement vehicle. But over the course of the last generation to two, that responsibility of saving for retirement has shifted from plan sponsor and the traditional pension plan to the employee. And as a result, employers, employees, intermediaries, the government are starting to recognize, I think, one of the main deficiencies in the defined contribution model in that primary role. So from a business perspective, as this slide is outlining here, employers are very aware of this, and they're feeling it every day. As we know, baby boomer, the largest generation in the history of the country, are retiring at an unbelievable rate, or should I say eligible to retire. And I say eligible to retire because of that lack of income, that lack of security. I think it's interesting to find out that of the individuals that had pension plans about 10 years ago, 1/3 of them no longer do. Those plans have been terminated. In a lot of cases, the benefits paid out as a lump sum. In some cases, the pension retained. And I think it's a staggering number that over 600,000 defined contribution plans in the country, covering the majority of participants that have access to retirement plans. Now, I say majority of participants, but really it's a small number. It's less than 2/3 of Americans have access to a retirement plan through their employer, and those that do, less than half of them are participating in those plans. All the while, still a good number of assets in those plans, as we all know. And now from a plan sponsor standpoint, as these deficiencies are becoming clear, and as it becomes obvious that a secure workforce is a productive workforce, employers are starting to put a greater emphasis on retirement and getting their participants ready for retirement. And we look at those participants in the demographic groups that they are. Obviously, we have baby boomers that are coming to retirement. We have the Xers who are, the sandwich generation, kind of the ones I heard. I thought it was good, kind of sitting back, watching everything burn. And then the millennials who are kind of the future here and really the largest group of individuals in the workplace. From a plan participant standpoint, most individuals look towards Social Security as the primary retirement income vehicle. It's important to know that less than half of your replacement income can be generated from Social Security. It affects higher earners more than it does lower earners, as it shows here. 41% of average career earnings is the replacement value of Social Security for those making, on average, $52,000 annually. Drops to 27% of replacement value for those making over $128,000. From a standpoint of surveys that we've read, specifically LIMRA that we're citing here, 2/3 of individuals not yet at retirement or about to join retirement, say within that 10-year window to retirement, say that their top priority is having their money last. And we know that defined contributions have been getting better at saving money and accumulating money and getting participation increased into plans. But what to do with it when they come to retirement is really the question that we're talking about here today. Another concern of participants, 57%, asked why they would choose secured income over a lump sum. Said it was because they expected to live longer in retirement. I think that thinking has changed from generations earlier. People understand that retirement is not a sprint anymore. It's more of a marathon. And about half of them just want the peace of mind of some kind of steady income. So as these kind of motivations and awarenesses become more apparent, plan sponsors are realizing that they have to do something, that they have to support their participants' retirement outcomes, that it helps their business, it helps attract talent, it helps retain talent, it helps businesses grow. And along the same lines, the regulators have been realizing this too. Over the past several years, we've seen significant changes, I think starting in 2006 with PPA, and we continue to see more today. In 2010, the Department of Labor and the Treasury did an RFI, a joint RFI, talking about the pros and cons of guaranteed income or annuities and DC plans and some of the barriers facing their implementation. In 2014, the IRS approved the use of QLACs or qualified longevity contracts to help defer some of the required minimum distributions and to introduce that concept of insured income annuities in retirement plans or coming out of retirement plans. 2015, the Department of Labor issued a field assistance bulletin that expanded on their 2012 safe harbor for plan sponsors when selecting insurance companies to provide annuities. I think that might be a little known fact in the industry, is that there is somewhat of a safe harbor out there going back 7 years that was then expanded on in 2015 with the field assistance bulletin. And then most recently, as I'm sure everybody is aware, with the Secure Act and RISA, there's more talk and anxiously waiting approval on such topics included in this legislation or proposed legislation of mandatory with disclosure of income amounts on participants' statements, further use of qualified longevity contracts, increase in the required minimum distribution age, and clarifications for fiduciaries when selecting insurance companies for in-plan annuity options. I think that the message is clear that this is something that is needed. It is important. I think the fact that the House passed this with only 3 no votes is a good sign. I think that it's being held up in the Senate. It really shouldn't be, but we can't control that. But I think it's moving in the right way. And even the Department of Labor several years ago, put a retirement income calculator on their website. So guaranteed income is important. It ensures that Americans will be financially prepared to enjoy retirement. Like I said earlier, I think collectively as an industry, we have the influence, we have the skill set to make this change. So today, we're excited to be able to bring Jay Washington to the webinar here and recently to the team here at DIETRICH. He comes here with almost 20 years of retirement plan experience. 13 of those years were with one of the, if not the retirement annuity leader, at least on an institutional basis with TIAA. Jay has been instrumental with the launch of ANNUA, and he's here to share with you his insights on the space and ANNUA's purpose. So welcome, Jay.
Thanks, Jeff. One thing I think that is definitely worth a point that really just occurred to me today as we were talking about this is it's interesting because Pension Protection Act was really designed to bring 403B plans, where I spent the bulk of my career, up to speed with 401k plans. And now it looks like as if Secure and RISA are bringing 401k plans almost in line with 403Bs and encouraging not focusing on the accumulation side of it. I remember starting in the industry where when you talked about your 401k, it was you got to have X number of dollars, but it never translated into what does that fund as a lifestyle. So regarding defined contribution plans, primarily on the 401k side, what the news has really been calling for is not only having those safe harbors in the retirement plan, for the retirement plan, for plan sponsors, but making them feel comfortable by clarifying exactly what they need to do to meet the fiduciary obligation. And Brookings, an institution I'm very familiar with from my days at TIA, actually did a study that suggested, it was just released June of this year.
A recent study.
Yeah, suggesting that plan sponsors auto-enroll their contributions into a deferred annuity, and they actually went a step further into looking at one that would start after retirement, so not necessarily at age 65. The primary driver for their study was longevity, and really taking a look at the fact that the average plan participant right now doesn't necessarily plan for the fact that they're going to be living 20 plus years in retirement.
Hopefully. I think on average, what, half of us are going to make it?
Yeah, I think it said about, it concentrated primarily on females, but there's usually about a 2 to 3 year age difference. But from a female perspective, had about half living to 65, about a third living, half living beyond their 85th birthday, about a third reaching 90, and 1 in 6 seeing their 95th birthday and beyond.
Wow. Something to look forward to, ladies. So from that standpoint, I think, like I said earlier, everybody's talking about this, thinking about ways to kind of shift that objective of the DC plans. And as I mentioned earlier, and Jay mentioned, we look at this from a standpoint of there's different groups of individuals. And you have a plan sponsor at the top of all of this. So we want to keep it simple for those individuals. We want to keep it transparent. Our focus here with our history and pensions and our thought process here is to let's make them defined benefit like. I've never met a individual that didn't like their pension plan. Even those that cashed it in, I think, had a lot of good things to say. Hey, thank goodness that this is here for me. But really keep that DB mindset, and how do we apply that to the DC plan across those different demographics, and understand that individuals need roughly 70% replacement income in retirement. And I think that something else that I didn't point out earlier is that the baby boomers are they're the ones that participate in these plans the most. Obviously, they're the closest to the retirement. It's on the forefront of their mind. But I think we have to find a way to also get the millennials involved. I read a stat that they make up 35% of the workforce, but 41% of them have no access to a retirement plan. So I think that's a problem, and it's short-sighted not to consider both ends of the spectrum here. So on that note, what we're really here to do today is to introduce ANNUA. And this, like I mentioned, this is our newest endeavor here at DIETRICH. And Jay, I guess, what's ANNUA?
ANNUA is our retirement income practice here at DIETRICH, really born about the fact that as we've been in the risk transfer business for nearly 4 decades now, we started to realize that if the guaranteed income stream that defined benefit plans provided to past generations is going away, what's going to be the replacement? As I mentioned, this is not a new concept. It's always been there in the 403B market. But, we mentioned earlier, reframing the objective, 401k plans always served as a supplement. You had your defined benefit plan, which will provide you that income. The 401k plan was really an asset to draw on as needed or to supplement that, not necessarily meant to meet your daily income. We realized that times are changing, so we needed to make changes to go along with that. So as we thought through ANNUA, we realized that it's not a one-stop shop, one type of income. Income really comes in 3 types with ANNUA. Income now, that's going to be for those who are at or near retirement. Hopefully they've already amassed and accumulated a good amount within their 401k plan, but they're getting to the point where it's no longer about accumulating, but it's about how to spend that down, which is the question that most people have the hardest time understanding how to think out and answering in retirement is how do they spend these assets down? Our Income Now solution is what's called a single premium immediate annuity. Those of you who are very familiar with frequently referred to as a SPIA. And we make those available and have been doing so for quite some time through an online system we have here called DIETRICH Direct Quote, where we have established relationships with some of the highest rated and most well-known insurance companies out there. And they can provide that income for the retiree. We'll get a little bit more into each one of these and give you an idea of what the challenge and solution is. So I'll move on to the income later, which is one that's a little newer to all of us, qualified longevity annuity contract, frequently referred to as a QLAC, really meant to meet income needs further down the road, and ones that, for those who are on the phone who have been dealing with 403B plans for a long time. Again, you're familiar with this, the accumulation annuities, where the idea is that you are buying income over the life of your career, saving now. If you have most of us have 401ks that offer mutual funds, we're putting money in there. It's the same idea, but instead of buying that asset that's a mutual fund, you're actually buying yourself income, an income stream that's going to be guaranteed for your life. Now, as I mentioned, when we talk about immediate income, the challenge is you're retiring within the next year and you've got this asset. What do you do with it? How do you make it work best for you? Well, with DIETRICH Direct Quote and immediate annuity, the idea is that you can take all or a portion of your retirement assets and turn those into an income stream that you will not outlive. And I believe the important part of that is all or a portion. So it gives you the opportunity to manage those assets as you see fit, provides you with that lifetime income, and also, because we have these relationships, and these relationships are on an institutional level, you can obtain higher income from these annuities because you're going to have overall lower pricing. Gives you the opportunity to do things efficiently because you have your income set up, and then any other resources that you were looking at spending down the retirement are free to remain as they are to draw down as needed.
Yeah, I think a couple things just to fill in the blanks, and maybe some of the tie back to some of the stuff that I said earlier. A MetLife study said that individuals will need, to replace basically 70% of their income. If Social Security replaces 40% of that, or 41, I believe was the number, there's a need there for more income. So we put an example on here that at current market conditions, which, let me just get this out there because we have some numbers in here that we're going to share. Current market conditions are probably, at least from a pure interest rate standpoint, not the best that we've seen historically. And I think that's important. I think that's important for those that are coming to retirement right now. I think that's also important for those planning for retirement, whether it's 5 years or 30 years down the road, because interest rates and generating guaranteed income through a annuity contract go hand in hand. But nonetheless, for an example, and keep this in mind because we're going to build off of this, current market conditions, $125,000 contribution to a single premium immediate annuity would buy about $625 a month guaranteed income for a 65-year-old male or female. Important guaranteed is underlined here. This is something that can't be outlived. This is insured. There's a lot of solutions out there, but there's only one solution that can provide a guarantee and that can't be outlived, and that's an annuity that is offered by a life insurance company. The other important thing off this slide is that it's not an all or nothing, right? Okay, it's a piece. It's a piece of the puzzle, and we'll show a slide later that shows you how that piece ties in. But this is the option right now for plan sponsors to give their retiring participants through our DIETRICH Direct Quote an idea of what their savings can generate, or a portion of their savings can generate, and to also access the institutional market with the carriers that are not only quality carriers but provide very aggressive pricing.
And that's a big part of it. Typically in the past, one of the aversions to annuities has been the cost. When you weigh the need for income and the opportunity for significant savings, you can see, and with the current legislative market, you can see why this makes sense, why this has been in the news. And while we're seeing more plan sponsors open to looking at this and inquiring for more information as well. That brings us to our next, and like as I mentioned before, really the newest of the three concepts, and that is deferred income upon retirement. What a lot of people don't think about is, and this is a huge challenge to to your retirement life, is the idea of how your needs can go up later in life at a point where you really are in no condition to go back to work. We typically are very, very concerned about our medical costs, and that's one of the things that becomes a much larger concern in retirement, and how those are going to be funded. Other things that people are concerned about are, making sure that you can save your money and that you can carry it through your retirement as long as possible. We've seen where some people are concerned that they have a certain amount they have to draw down, need it or not, that they have to draw down beginning at age 70 and a half. And I know Secure is looking at raising that because it's been a long time since that's been changed, and it is based on life expectancy. But with the qualified longevity annuity contract, the idea is that it allows you to defer some of that income till later in life, typically beginning no later than age 85. And the idea behind that is that money is, the legislation allows you to put 25% of your retirement savings into a QLAC up to a maximum of $130,000. So I always like to clarify that it's going to be the lesser of the two, 25% or $130,000 into that qualified longevity annuity. And again, typically beginning sometime between retirement and age 85. Those funds are not subject to the minimum distributions. And another benefit to it is that because you will be starting the income at a considerably later age, your life expectancy will be lower. It will generate a significantly higher amount of income at age 85 than if it was taken at age 65. So it is a way to be able to meet those needs later in life, to address RMD concerns. And again, it really mitigates that longevity we talked about. When you think about 1 in 6, some would say 85 seems a bit late to be starting income, but when you look at 1 in 6 individuals living beyond their 95th birthday, then it becomes considerably more attractive to consider this for a portion of your income. I would also interject, and I've discussed this with Jeff before, I think a perfect example is when I look at my grandfather, who had to go into specialized care in his early 80s. Fortunately, he had planned ahead of time to fund that. The QLACs weren't available, but this would have been a great option to give more comfort that he had the income needed to meet that. So these are some of the things to really consider when you're looking at deferring income even in retirement.
Yeah, just to tie the numbers back into it, as it says at the bottom of the slide here, that same $125,000 that bought $625 a month at 65, when you use that $125,000 at 65 to purchase a QLAC under current market conditions, we're talking roughly $4,000 more a month payable starting at 85. And there are death benefit features on a QLAC. I know one of the knocks against annuities is, when I die, they're gone. On one hand, I guess you can't take it with you. On the other hand, it's not always the case. In our prior example for the $625 a month, there's a 15-year guarantee on that. That's a 10-year certain in life. With the QLAC, it offers a return of premium feature if you die before it starts. It also has other death benefits and other features that go along with it. So I think the misconceptions about annuities, or maybe the perceptions about annuities out there, are one of the biggest things that have to be explained. And I know in future webinar series, we're going to get more into each of these solutions in detail. And again, as an industry, I think we have the ability to change that perception. And I think that this next one is one of the best ways we can do that.
I would agree, Jeff. When I look at the three, forms of income that we've discussed today, this is where I really see the biggest change in the future of the 401k plan going, and that is the income accumulation, where you are saving into an annuity over the span of your career. It meets so many of the points that we've talked about already. The fact that there's a shift from the defined benefit plan. I have to laugh. My grandmother's no longer with us, but I remember when I left TIAA, the first thing she said is, well, you put in 13 years, you know, you're going to lose your pension. And I had to tell her that, you know, it didn't work that way with me. I was going to be taking it with me. Well, the portion that you can, it's not, you know, limited to a lifetime income. But we really want to, that's one of the biggest challenges, putting that pension aspect back into a 401k plan and changing the focus from accumulation to what that accumulation will actually provide for you and how to spend that down. What employers are starting to see now is that because so much of the ownership of providing retirement income with a 401k plan rests on the employee, that they're having a hard time with employees retiring. And as we know, older employees tend to be more of a cost to both in productivity, healthcare, number of costs rise for the employer. So they're looking at ways to say, how can we make it so that our employees are retirement ready? That's their biggest challenge. And that's where we see the solution being the accumulation annuity. And the first part we need to do is, again, really getting plan sponsors to feel comfortable and naming an annuity or an insurance provider to take those accumulations, allow participants to save, and then ultimately be able to make good on those payments. You know, it's very similar to the defined benefit plan, wherein, you know, you're saying, I want to make sure that I need to do everything I can to make sure that I'll be able to make good on the promise I made to my employees. You want the same thing with the insurance company. There's been a huge, huge shift towards providing benefits estimates on the statement. And I can speak from personal experience. One of the benefits of that is, you know, you get your 401k statement now and you see the you see your balance. Typically, we're all very excited. You know, we see our balance going up. I know for me, it makes me want to contribute more. When you can actually make that balance more realistic, not only can it make a person want to contribute more, it can also really let them know how are they doing.
So realistic from a standpoint of how much income is that going to generate?
Exactly.
What does that mean?
How much income can I replace? You know, it's one thing, I use this example. You know, if I tell you, hey, you've got this pot of money with $200,000 in it, you know, many people will say, wow, I'm doing great. If you tell them, by the way, that $200,000 based on your life expectancy is going to give you $400 a month in income because you're going to live 30 plus years in retirement, that's a completely different story. So with that benefit statement, it will allow plan participants to know earlier on, how am I doing? And that will then tie into the challenge of helping plan participants with retirement readiness.
So that idea, you know, of auto features that have come to defined contribution plans, auto enrollment, auto escalation, we've seen them benefit. I know I've read stats on how much that's increased participation. I think what you're saying is to increase awareness now of what that participation is doing.
Exactly.
Is what the Secure Act and research trying to do by adding that income amount to the statement, which DDQ can do.
Right.
Is like the third leg of that stool, so to speak.
Exactly.
In getting prepared for retirement.
Again, when we take a look, you know, once we get plan sponsors to understand all the benefits, the concern then is, you know, is this going to be difficult? How do I communicate this to my employees? And that's where DIETRICH comes in. You know, we work with you to implement the K annuity, and we also work with you on being able to provide education so that you can really drive home what that benefit is, because there's no sense to providing a benefit that's going to be beneficial if you don't tell people how and why to use it. When we look at guarantee
So again, going back to the numbers, and this I think is my favorite slide of the group, this is showing the benefit of the K annuity model. Again, we look at this and we're doing this from a standpoint of the employer contribution, whether it's the profit sharing contribution, whether it's a safe harbor amount, discretionary match, in directing that employer contribution into buying pension income over the working years of the individual. What we're showing in this slide here, and just to give you the basis of this, is we're talking about an individual. We started this at age 30, making $30,000 a year with an annual salary increase of 3%. So from 30 to 65, the plan sponsor contributing 4% a year towards the K annuity, total contribution of about $75,000, and then the payout side of it at the end of all of this, the pension, so to speak, being paid in the form of a 15-year certain in life benefit. For those of you that may not know what a 15-year certain in life, that first bullet point summarizes it. Basically, at retirement, under this model, the individual would generate almost $14,000 of annual income with a minimum guaranteed payout of $200,000. That minimum guaranteed payout is that 15-year certain feature. That's what I was referring to earlier, that you start this today and you die tomorrow, it's not over. Your beneficiary is going to get the remainder of that guaranteed period. And oh, by the way, if you do live beyond 15 years, which Jay said, half of us are going to, it's going to keep going, and it's going to keep paying you that same amount. That equals about 35% of what's left to replace your income, or 35% of what Social Security can offer. On the prior slide, we said that a contribution of 6% would roughly equate to about half of what the individual's Social Security benefit will be. In this example, at 4%, it's about 35% of the total Social Security benefit. This model generates $5,000 more a year income than putting that 4% contribution into some kind of other investment, like Jay mentioned, the traditional investments in the plan with an assumed 5% growth, and then annuitizing it at retirement. So again, going back to that first slide, $125,000 will buy you $625 today. This generates $5,000 more on almost a $14,000 payout. The other thing to look at here is, we all know the philosophies in savings, starting early. You can see the steepness of the curve here. 1/3 of the total income generated under the K annuity model happens in that first 10 years. Almost 2/3 of it, the total income generated in half the time, first half of the savings cycle. So it's important to start early. This is ANNUA's approach to millennials and some of those Xers if they're lucky. But this is our approach to the next generation. This is the next generation of pensions.
All right, so we take a look at guaranteed lifetime income. Things you want to consider: it's an enhancement to the plan and can be added at little to no cost to the employer, and it has an income guarantee, and this is what's really important, that other investments don't offer. We work with some of the largest and most established insurance companies out there. So that adds that extra layer of comfort to the plan sponsor. And it is, the flexibility also allows you to tailor it to your plan and what your goals for the plan are. And the institutional pricing is good for you in that we're all, within the industry, we call it the race to zero. Everyone wants to get costs down as low as possible. So the institutional pricing is good in that it provides that alternative such that your employees in the plan who want an annuity don't have to look at taking money out, rolling it over, and purchasing one on their own. So we've talked about that. We talked about the importance of income, why you should add it. The next thing we want to take a look at is what the process is. This can really be accomplished in about 5 easy steps. Jeff and I joked and said there should be a 6 because number 1 should be call Jeff or Jay. But besides that, the first thing you want to do is to amend the plan, review and select your providers, notify plan participants and beneficiaries of any changes made to the plan, modify summary plan description and election benefit forms, and establish procedures for administration of the option as well as the 5500 filing.
I think that's it.
Yeah, that's it. I was going to say that's it. Ends my regularly scheduled broadcast for the day. Jeff, did you have anything else that you wanted to add?
Yeah, just in conclusion, we're going to open up to questions here. I think Jay and I both like to talk. We went a little longer than we wanted to, but I think it's debatable whose responsibility, it is to kind of provide retirement income to the participants and provide to plan participants and security. Here at DIETRICH and through ANNUA, we're willing to accept that challenge. I think that, again, like I said, right off the bat, as an industry, we have the ability to do this. I think we have the products to do this. It is not all or nothing. It is a piece of the puzzle. And we've been helping insure pensions for 40 years. And with ANNUA, we're going to be insuring defined contribution plans for 40 years until pensions come back, because everything's cyclical. So on that point, let's open it up. Krista, do we have any questions?
We do. I've got one here, and it reads, can I get direct quotes for JNS, joint and survivor annuities?
Yes. All of the traditional options that you see in pensions are available on the DC side too. It's very similar to what we do on the pension side. So you can get JNS. You can get actually them based on first death, or the traditional that we see in the pensions where it reduces with the death of the participant. You can get the guaranteed or the period certain in life, basic period certain, obviously the life only benefit, cash refund benefits. We can add cost of living adjustments to those for inflation protection. So there's a lot of flexibility from a standpoint of the different types of payout options on the immediate side. So that's SPIA, that income now. There are as well on the QLAC. The QLAC's a little bit different in a way that you select some of those things up front with some products, and I think that will evolve. And then from the K annuity standpoint, the plan sponsor can dictate the options that they would like available, and that's built into that product. Again, think of a pension. It's very similar to that, and what options would be provided. So simple answer, yes. Long answer, maybe that too.
Okay, great. We've got another interesting question here. It says, are we limiting accumulation potential with the K annuity? Will millennials in general respond well to that?
That's a great question. I think that, first of all, we have to get millennials interested, in the plans and give them access to the plans. Personally, I think they would be interested in that. I don't know. I know that I read a statistic that 13% of individuals age 60 or older don't have anything saved for retirement. That's scary, right? Do we want to put the millennial generation in that position? Also, how were pensions accepted? Back when they first came around. Do you think somebody is gonna turn down that? I think last point, like Jay's chomping at the bit over here. I must have said something. If you go back and you look at this prior slide that talks about the K annuity and comparing it there, I think in the third bullet point, if you just, and this is all based on today's rates. So one of the things that we know is interest rates aren't going to be the same for the next 30, 35 years. If I could tell you, a 65-year-old today, that 35 years ago you could have put your money into the K annuity product, I think you would rather be entering the market with the benefit that that would have generated under the interest rates over the last 35 years than you would today. Even that still, everything being equal, if you assume 5% growth on those employer contributions in this example, the income generated from the K annuity is still more than that, turning that around and buying income at 65. So assuming that we agree that generating replacement income is important through an annuity contract, yeah, I believe that millennials will like the idea of the employer portion of the contribution going towards a pension. I've talked to millennials. I'm not a millennial, but I'm not far away from it. And they know what pensions are. They've seen their parents cash them in. They've seen their grandparents live off of them. So they're aware of what they are. And maybe that's why they're not contributing. The ones that do have access, maybe that's why they're not contributing to DC plans, is because maybe they don't value the current model. Turn that back around. Go ahead, Jay.
And I'm happy, the submitter of that question, I'm happy to have him follow up with me, but I need to search for it, but I've actually read a couple of studies that show millennials value the idea of saving and having an income stream in retirement over the investment aspect of it, if you will, in retirement. It's been quite some time, and I'm happy again to follow up on that. But just in my interactions and talk, I have a lot of millennials that I'm friends with and that are related to me, and they understand the idea of saving for retirement, and they want to be able to generate an income stream. Where I've heard the most aversion is because so many of them are in student loan debt.
Well, I was just thinking that. I think there's other priorities there, and I think that actually would make it even more appealing to them.
Right.
So.
Great. All right, we've got another one that came in, and it's how many annuity companies do you partner with?
It depends on the product, but it's growing. And one of the things that now that ANNUA is launched, you'll be seeing announcements come out with our partners. So depending on the product, there's a different number of insurance companies. Started with the traditional PRT market where there's 16 insurance companies in there, and we've been expanding outside of that. So more to come on that unless there's a specific product that you want to talk about right now. But it's enough from a standpoint of choice. I think that's something that we didn't really harp on too much here, is that there's two different ways to look at this. You can look at this as a single provider from an insurance company standpoint, or you can look at this as a multiple provider. They both have their benefits, I think, and I think it's really at the discretion of the plan intermediaries, the plan sponsor, as to which model they want to look at. But there's several carriers under each product, or solution, I should say.
Great.
And that's something else, Krista, that's something else, like Jay mentioned on the millennial question, that if we can follow up one-on-one with that.
Absolutely, absolutely. And I did want to remind everybody, any questions that we did not get to will be addressed offline, because I think we're kind of wrapping up on the amount of time that we have for today. So I wanted to go ahead and thank Jeff and Jay for a great presentation, and a replay of today's session will be sent to all attendees via a follow-up email. And please keep an eye out for future webinar invitations. We'll be continuing to discuss ANNUA and all of its great features and a few other exciting features with ANNUA as well in the future. So keep an eye out for those. And on behalf of the panelists and organizers, thanks for tuning in, and have a great afternoon, everyone.
Thank you, everyone.
Thank you, everyone.